revamped his process for collections, etc. And his cash flow is like, it's amazing. It's like an extra $25,000, $30,000, $40,000 a month in actual cash revenues collected just by paying attention to that.
Money sorts itself out when, the higher margin it is, right? Life gets easier. And I'll riff off of that. That cash collection cycle, the cash flow cycle is huge. So quick turnaround on executing, bill early, and then collect early. And that often, if you can collect some or all up front, you've just done it. My favorite example is Dell. Part of the way they were able to scale so fast is they sold a computer online or on the phone.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Welcome to The Business Coach. I'm your host, David Finkel. You have a real treat in store for you this week. My guest host this week with me, co-host, is Kevin Basset, CPA. Kevin is a dear friend, but he's also a very smart, sophisticated, 25-year plus veteran as a CPA working with small and mid-sized companies, some of which are venture-backed, some of which are just organically grown by business owners. He's helped his clients grow their companies from $1 million, $10 million at the starting point to $50, $100 million or more. Kevin is a business owner in his own right who's run and still runs multiple businesses. And so he and I this week are going to be talking about cash flow and how to manage that. You're going to hear Kevin and I talking about what your cash flow cycle is. When does it specifically start? When does it end? How can you accelerate or speed up your cash flow cycle? What are the things that make it more difficult to manage cash flow? And what are the most costly mistakes that business owners make when managing cash flow? And what are the things that the smartest, most successful business owners do that make managing cash flow easy and simple? That's all in store for you in today's episode of The Business Coach. Kevin, it's great to have you back co-hosting The Business Coach. It's where you belong, right? This is where you need to be, isn't it?
Absolutely. Love it.
It was funny. So I was talking with another one of your team members, Anne, earlier today, just happened to work out that way. And for those of you that are in our audience, so Kevin is not just a really, really bright individual, but he's also a pretty darn good business owner. And he's a passable CPA. We'll give him passing marks on that part.
That's all
but
I
in
need.
his office, Anne is one of his tax managers, and I've been a client now for, I don't know, over 10 years. Anyway, so I was talking with her about something different. But I want to ask you this one, Kevin, before we get into the topic that I've laid out today for us, which is on managing cash flow. How is it for you? I'm just curious. What's it like for you? You're in a world that as a CPA, everyone thinks about it as seasons, tax season. Oh, it's brutal tax season. And then you have all your people who extend for the next date and have to file in September. And then you have your fiscal year end people that file at weird dates with that. How is it for you now in your life as you've been doing this work, like we talk about on The Business Coach, and you've been working to make your firm stronger, better, and more enjoyable to own? How has it gone with you making the business fit your life better than you fitting your life completely revolving around the business? I thought we'd start there before we jump into cash flow.
Yeah. Well, it's been a fun journey. In fact, this week, coincidentally, as we record this, is the exactly 25 years since I left Ernst & Young and, started this and out of my house, just cranking out returns, in the house, listening to 80s tunes. So it's come a long way. And with that, we've gotten smarter about how we arrange it. So life is a lot better, and not just for me, but the team members here, right? We've managed the schedule smarter. But to answer your question, I guess the proof is what we do. I live at our beach house 40% of the time and take much longer trips than I could have imagined at the time, but both because we have the money and the time. So a lot better now, and that's good, because any business owner that can pull that off, you can stay in the game longer, and that means a lot more wealth you can build over your lifetime instead of burning out and cashing out, right? So it's managing time well is the name of the game, but it is a journey to get there for sure.
You said something I want to come back to. This idea that you said two things. Three, I guess. Congratulations, 25 years now where you went out on your own, and I'm laughing and smiling about doing it in your kitchen early on. I remember for me, it was a spare bedroom, and my desk was in the hutch, was in a closet with this part. But
yeah,
two things I want to come back to. One was this comment about staying in the game longer. I did an earlier podcast episode about optionality, Kevin, about this idea that in a business, that one of the reasons to build a company the right way is that you have more choices at the end. Now, everyone tends to be, culturized or inundated with this thought that the only real exit for a business owner is for her to sell her company. But she might choose to own it passively longer, or to own it semi-passively and straddle working 10, 20 hours a week and taking, 10, 15, 20 weeks off in the course of a year with that part. And this comment, because I had it earlier with another business woman, the comment about by you staying in the game longer, the actual company has a huge growth rate that happens because it's the final 5 to 15 years of a business that you're compounding the first 20 years in the business.
Mhm.
And you're a good example. Even if you're growing at 10, 15% a year, 10 or
Yep.
15% of where you are today is much bigger growth in raw terms than where it would have
Mhm.
been, 20 years ago when you started. I'm curious if that sparks anything for you.
Oh yeah, that's exactly how I'm approaching it. And you're right. If you just stay, that's exactly where I set my growth corridor at the 10, 15% now that we're mature. That means you're doubling every 5 to 7 years because of that power of compounding, right? The rule of 72, and that's your number. And so by staying in the game, you get that many more years of cash flow. So you're not drawing on assets, and that asset, you still have it, and it's compounding. So being able to do that, you have a much longer, we talk about health span and lifespan in life. Well, the same is true with the business, right? It has its own health span and lifespan.
I like that analogy, this idea that my business has a health span and lifespan. And so my participation, if I can extend it, and if it requires me to get a longer participation by making accommodations, but my business is healthier for me having participation. And I think by and large, most businesses are better for the owner being involved if the owner has taken to heart what we've been talking about in the podcast
Yep.
and doing these things. That makes sense to me. I like that idea. That's part of the health span of a business.
Yep, exactly right. And if the business owner is involved in a healthy way, exactly right.
Yeah.
Yep.
So talk with me let's jump over here. The topic I planned out for us today was on managing cash flow. And, you know, 3 times this week, Kevin, it came up with clients that I was talking with, whether it be over the phone or by email threads, trains back and forth, this idea that they were struggling to manage cash flow. And when we think about cash flow, I think probably one of the things that really screws us up to begin with is not having a way of seeing the cash situation. It's one thing to manage cash flow, but it presupposes that I know what's going on from a financial standpoint. So let's start talking about that first.
Yep, absolutely. So your question on managing cash flow, right? It starts with, are your books right in the first place? Do you have current up to the minute books, as far as your bank account's concerned and the associated cash inflows and outflows? So one of the biggest things I recommend is, keep current books real time. And there still is a small segment of business owners, probably not as much as the old days where they think they've got in the old days, you get a box of stuff and crank out your books the following year. So your, CPA can prepare a tax return, and that's just awful. It's a meaningless management tool at that point because it's literally a year old at that point. But nowadays, sometimes we'll see that, maybe they'll pay some bills out of their QuickBooks or something like that and expect their accountant, their bookkeeper to catch it up after the fact. And we're big proponents of keep it real time. And most of our clients now are large enough that is the case, but there's, millions and millions of small businesses out there that aren't doing that. And just remember, your books are for you to manage your company, to manage it by the numbers, not for your CPA to fill out some tax forms every year. That's crazy. So use them real time. But it all starts with current numbers.
Yeah, and it's interesting your comment about, keeping it current in real time. I'll come back to that. But this idea of, do I have timely, accurate financials? I've got clients, Kevin, and we look at the coaching side that the worst case scenario, they might be 90 days before they get financials for 3 months ago. I mean,
Yep.
I look at that. That's like my kids driving a car. They look immediately at the car in front of them, but they're not seeing what's further beyond than that. That's why,
Right.
their insurance rates are 5 times higher than the rest of
Yep.
ours. Side note, one of my kids was driving on this dirt road, came back home, and I'm watching him try to push the front end of the car back onto the car. And
Yep.
he's trying to talk to me and convince me, Kevin, that's normal, that it's just cosmetic. And
Yep.
I'm trying to tell them, well, that's okay. Good learning lesson. We will take the car to get inspected and we will get it paid. The good
Yep.
news is that's going to happen. And the even better news for me, anyways, is you'll be paying for it.
That's right. Yeah, exactly. No, we had it one time. My daughter met her friends at the mall when she was in high school. It's my youngest one, and that mall has a parking garage. And when she was backing out, classic new driver mistake. She's looking out back, but not watching her front bumper swing around and hit a nice concrete pillar and did some damage. So she shows up at my office while I'm at work, hoping that I can fix it before she goes home to mom, right? Because she knows I don't care about cars and would handle it better and maybe have the skill to fix it. But it was unfixable. But that's classic new driver.
That's
Yeah.
great.
Yeah, a lot of
So when we
fun.
look at financials, Kevin, like I'll tell clients commonly things like, look, at a minimum, within 30 days, you have your financials for the prior month. Your target should be at least the 20th of the next month, if not the 15th. What do you see as actually doable? Because sometimes I'll hear a client say, well, my controller says that's just not possible. It's unrealistic. What is the range of what's realistic to have the
Yeah.
timely part of financials done?
So on the short end, highest performing, try to close by the fifth. But we're talking high performing companies with some financial sophistication and tech and the internal team to do it. And then 15th is probably more realistic. We try to have our revenue finished by the 5th, and then our balance sheet closeout happens after that. So even us as CPA with a team of accountants, we're closer to the 7th. Revenue by the 5th, and then the balance sheet tie down by the 7th. If you're doing by the 15th, you're doing pretty well. However, the caveat is if you're maintaining an accurate bank account in real time and just doing your balance sheet closeout, balance sheet tie down, and you're closing your books by the say 15th, you're still dealing with pretty current information, right? Your bank is right. And bank isn't everything, right? That's called the BS method, the bank says method, but it is the start. And today's topic is talking about managing cash flow, and that is indeed your bank account.
I'm laughing. So when we were talking before about real time, but your comment about BS being the bank says, I mean, it's the business owner who said, hey, I had money when I looked online and saw that there was $360,000 in the account. Why should it be a problem that I ended up buying the new truck for the business or this other one, which you and I both know that's ridiculous because
Yep.
that bank balance doesn't account for the 6 other checks that still haven't cleared and hit for the account, or the accrued payables that you might have for another $200,000. And all of a sudden you're wondering, why am I overdrafted, or why am I so tight that I'm scared about my cash flow?
Yep, exactly right. And the bank recon is something, by the way, that the business owner should be in their monthly packet getting a copy of, because one of the most important things in the bank recon is the section on there called uncleared transactions. And one, you got to see what's not cleared, or two, you got to see if there's a bunch of stuff that's completely bogus, like duplicate deposits or duplicate checks. And I had $1 for every business owner that does not look at their bank recon in detail. And it takes literally, 30 seconds, but it tells you everything. That unclear transaction is the most important part. And it'll also tell you in a hurry if you've got a good bookkeeper or not.
Give me the short list. What you mentioned about this monthly packet that a business owner should look at, right? And some of that's inside of the financials themselves in whatever software they're using, QuickBooks or whatever, but
Yep.
some of it's not. Give me a quick short list. Just shoot them out.
Yep, absolutely. A balance sheet comparative and P&L comparative, right? Compared to prior year. So one thing to remember is a financial statement is completely worthless if it is not comparative, right? It's the change in the balance sheet that matters, not just the balances themselves. And that's something that someone will literally learn in their very, very first day of the most elementary, high school or early college accounting class. And that's important to know. Also it's a litmus test if your bookkeeper's any good. And now because of QuickBooks, you've got this whole slew of quote bookkeepers that have literally never set foot in a single accounting class. So how's that going to work out, folks? But QuickBooks has kind of enabled that. But to continue on that, your comparative balance sheet, your comparative P&L, and by the way, balance sheet's most important, and a lot of folks don't even look at it. Next, you'll want to look at your bank reconciliation, the detail, right? And you're going straight to those uncleared transactions section. Then you're going to want to look at your accounts receivable aging, your accounts payable aging. And those should tie to your balance sheet, by the way. And then some sort of dashboard. And that's going to be dependent on your company, right? What's that one pager that you need to see of key things?
Yeah, I love that. I love that. So the first the first hurdle for us as a business owner is, do we actually have timely and accurate financials? Timely, we talked about here, by the 20th is probably the minimum standard, and the 15th would be even better if you're solid. And if you're a rock star, maybe you can get it done by the 10th or even earlier. Accurate, right? Doesn't do us any good if the information in there is junk. But the second piece in here is, are you looking at it? And
Yep.
you and I both know, Kevin, many, if not the majority of business owners are guilty of either not really spending time with their financials or truncating it and looking at the shortcut version, which is they look at revenue straight to quote unquote profit and they're done. And they don't realize why that's setting themselves up for failure.
Yeah, that's right. A pure P&L mentality. And literally, a bunch never look at the balance sheet. And sometimes even the bookkeeper doesn't look at the balance sheet. And simple accounting math, right? The simplest of math, 1 + 1 = 2, is that all financial statements are the difference between the beginning and ending balance sheet. So if either of those are wrong, it is a mathematical impossibility for your P&L to be right. And I had a hilarious CFO meeting with one of our clients. Had a new bookkeeper. He hired that person against our advice because we give all our tests out for free, and this person failed the test spectacularly. Hired anyway because he had a good feeling, and of course that person's already gone. But we look at the P&L and go over the balance sheet, and it was all jacked up. He's like, "Well, I'm 100% positive, Kevin, that the P&L is right. It's just next year we'll work on the balance sheet." I said, "Well, I'm 100% positive the P&L cannot be right, because of the accounting equation." So, yep, and you got to look at it. It starts with the bank statement, right? I recommend that the bank and credit card statements get mailed to the business owner's home. And my bookkeeper's not even allowed to do the recons until I've reviewed them and marked them up. Even though she could do it, we've got electronic access, but that's our internal control, right?
Yeah.
You
And,
should
it's
actually
interesting.
open it and look at it. Yep.
It's interesting as you say that, because one of our clients had an issue with his bookkeeper was putting through a lot of personal expenses on the credit cards.
Bingo.
And all of a sudden he's finding out there's several $100,000 over the last several years. And what he would have said to me, like many of us would say, I trust this person. She's honest. She's committed.
Yep.
She won't even take a vacation, Kevin, because she's that committed to the
Huge
company.
red flag.
Red flag, red flag, red flag.
Yep. That's exactly right. Yeah, and because they do take a vacation, that's how certain fraud techniques get nailed. Kiting being one of them, right? And then in the case of she's running expenses through, she wants to be the one to open those statements. Yeah, we've done the same thing, right? Where business owner wasn't looking and finally sensed something was wrong, had us come in. They were not a bookkeeping client. We came in and sure enough, she was paying her utility bills and car payments directly out of the bank account, but she was the one getting the statements and opening them. And same can be true. Incidentally, that one bookkeeper I was talking about, we got on one day. What was the final? It wasn't her incompetence that got her fired. It was, we get on one meeting. I was like, "So how's so-and-so doing?" He says, "Well, she helped herself to a raise." She was also in charge of payroll. And it took them, 4 months to find it. And that's what finally ended her career, even though she was also incompetent.
Yeah.
Yep.
So, I mean, look, if I had to have someone doing something illegal, I prefer them to be dumb than smart. So at least they get found out sooner. But, I'm going to go back to this test you talked about. So those are our audience here, Kevin, won't know this, but I'll share. So, our controller currently is kind of retiring from work. And so we were looking for her replacement, and she's been great about giving us a long lead time. Hey guys, 2 years. Hey guys, 1 year. Hey guys, 6 months. Hey guys, you're ignoring me. Because we didn't want it to believe it to be true. And like many business owners, our heads are, up
done that. Yep.
in the sand or something. We'll say that. Anyways, Kevin, so we took your test, and one of the things though we had to figure out how to do is a little bit awkward. But with with the world of AI, we can't just give them the questions anymore. We have to, okay, we want you on the test. We want to see where your hands are, and we're going to ask you the questions, and we need to see your hands, and we want you looking at the screen here. And it worked. The person we had several of our candidates that we did that through, and they were in the high 90s or mid 90s on the test, and we felt good about it. But who would have ever thought that you had to actually watch them do the test, like proctoring it, unlike in the old days where you could just give them a test, they could send it back because they couldn't easily find the answers for everything.
That's exactly right. And so when we do it, if they're a local hire, we put them in the conference room and they need to leave their phone in a basket, and we have an actual basket. And if they're remote, we have them do it on Zoom so they can be watched. And it also allows us to time them. That's another important thing. If they take forever, that's almost worse than being incompetent in our business. But we did have one remote one, right, where we couldn't control the environment, and we got to what's called the top grading interview. We used the top grading process, and she was exposed within about 5 minutes of extraordinary incompetence. But so clearly, the test was not her answers, right? It was either AI or a friend. So that was pretty funny. Yep.
So now we have good information and we're looking at that to manage cash flow. Let's start with collections. I think one of the places, like one of the professional service firms we coach for them, they were not struggling cash flow. They've been in business for over 20 years. They're not struggling cash flow wise, but the owner did not regularly look at his financials. And one of the parts I pointed out to him, I said, look right here on your balance sheet. You see this part that is your receivables. Now, if we were to do an aged AR report, this receivable number, which is for him, is close to 7 figures in his professional service firm, there's a lot of stuff that's probably uncollectible at that point with that. It's gone too far. And so as we looked at it, we started paying more attention to that. We revamped his process for collections, et cetera. And his cash flow is like, it's amazing. It's like an extra $25,000, $30,000, $40,000 a month in actual cash revenues collected just by paying attention to that.
That's exactly right. So yeah, that's referred to as the cash flow cycle. And it's super, super important to have that. And really in the world of cash flow, there's kind of a 10-10-10 rule that some might be useful. And one is that your accounts receivable, in general, you don't want it to be more than 10% of total revenue if possible. And what that is, that's 30 days of receivables, which would give you to what, 8.3%, plus a little bit of lag time, right? Because it takes you a few days to get the billings out, probably if you bill at month end. So that's a kind of a minimum. Now, if you can collect early and accelerate that and run your receivables during the month, you can do better than that. But that's kind of a maximum there. And that's a sign of a healthy cash flow cycle. And if it's longer than that, means you probably got some old stuff on there. And old means two things. One, the cash isn't in your bank, right? So you got to float more working capital. And two, the odds of collecting it go down, right? The older time's the killer. So that's the first 10%. And second 10% is you should maintain normally about 10% of revenue in working capital if you have normal margins and a normal collection cycle and you don't have massive seasonality. Some will need more than that. And the final thing is any business, almost any business, with a possible exception of grocery stores, should have at least a 10% net margin. And the higher your margin, the easier managing cash flow is. And other businesses, of course, by industry should have a minimum of 20, and a professional service firm should have at least 30%. But that 10-10-10, are some minimums that can apply universally to all businesses as absolute minimums. And anything worse than that, you're going to have a hard time managing cash flow.
As you say that, it's interesting to me. So first of all, I'm going to come back and unpack a couple of things here. We talk about this cash flow cycle, and in some businesses, and just to define that, right, that's the moment you have, it starts there where you have money going out for cost of goods sold, and it ends when you've collected the revenue for what you produced with that part. So
that's right.
If it costs me $10,000 to pay my employees and my machinery to produce X, I get my $25,000 back in 30 days. That's a 30-day cash flow cycle. And so a lot of businesses never look at that, and that might be 60 days or 90 days. And the very best businesses will even have a negative cash flow cycle, which means they collect before they have cost of good going out, and that's fantastic. But going back to it, one of the easiest ways that I see for service-based businesses is many owners started building their system for how they do collections back when it was them doing the collecting of the money. They were uncomfortable. They were really busy. It wasn't their full-time part. They didn't value it as much. So they would do once a month, sit down and send out all their invoices, which is idiotic. At the very least, they should be sitting down once a week, or their person once a week sending out invoices, so that, if I do work for you, Kevin, I don't wait till the end of the month to bill. I bill right away. And so you don't get 4 bills every month. You get one, but you get it sent sooner once I am at a point where it's appropriate for me to bill. And yet probably most businesses don't do that. And then those that can, why not do it every day for those businesses where they have the staff and it makes sense for that part? And that speeds up most collection cycles by 10 to 30 days just by doing that.
Yeah. The average would be 15, in fact. And exactly. And Dylan, and same thing. We do it here. The old days, accounting firms absolutely did it all month end, but it was we charge for our recurring stuff, and then tax returns, when we complete it. And there are some things, consulting and those kind of things that are month end, but we try to keep that to a minimum. And exactly right. And to your point about the minute you start incurring that first dollar is when your cash cycle starts. And in a product business, also when you buy the inventory. So if you have too much inventory up front and you're holding it too long, that kills your cash flow. But service businesses think, hey, I don't have inventory, that doesn't apply to me. But oh, yes, you do. You have people and you're incurring hours. And in fact, sometimes that stays longer. So for any business, turnaround time is super crucial. And you could make the argument that a service company, perhaps it might be even more important, right? The velocity of money really matters.
Yeah, and your inventory in a manufacturing company that has, raw materials or work in progress, this other stuff, if I don't sell it today, assuming it doesn't become obsolete or damaged, I can sell it tomorrow. And
Yep.
even in 12 months, maybe I can sell it for a discounted amount. But inventory spoils the moment it's gone, it spoils. You can no longer sell yesterday's work hours. It's gone.
That's right. Yep. That's exactly right. Yep. So service companies, we really have two numbers to manage, right? Revenue and labor. And that makes it simple. It doesn't mean it's easy, but it does make it straightforward, right?
Yeah.
Yep.
And so just to give people a couple margins to think about, right? You mentioned here professional service firms, targeting at least a 30% plus operating profit margin.
Yep.
Home improvement business, I would hope that you can target at least 10%, 8 to 10%, maybe
And
targeting
certain
15%.
trades can get 20. That's exactly right. Yep.
And then a service business in general, I'm going to probably target a minimum of 20%, but I'm going to try to get
Exactly.
myself 25 to 30% or greater.
Yep. Minimum of 20 in service. Exactly. Yep.
Yep. And what other kind of heuristics can you give us? Again, you get a look at a lot of these. I look at a lot of these. What are a few more that you want to throw out here?
Yeah. And really, any business with the exception of, say, grocery stores and grocery store adjacent should be a minimum of 10. And if it's less than 10, you could make the argument of, is this business model worth pursuing? Warren Buffett, by contrast, he won't touch anything in his portfolio that's not doing at least a 20% operating profit margin. And that's his minimum threshold. And he's a pretty smart fella. And I would agree. Professional service minimum of 30. And then that'll differ by certain segments. The CPA firms, for example, the ideal is 40% or better. And it took two business coaches to get me contained, with you and getting mine north of 40. And what a difference it makes, right? Money sorts itself out when, the higher margin it is, right? Life gets easier.
Give me a few more, give me a medical practice and then give me we'll call it a white collar service business versus a blue collar service business.
Sure.
Blue collar service being like a HVAC company or electrical business, and a white collar maybe doing IT services or something, and then a medical. Give me the three more.
Definitely. Well, medical is interesting because so it used to be, I could answer that in a heartbeat at north of 30%. What's happened, unfortunately, is the reimbursement rates have not increased as much as inflation has, specifically the labor inflation of it. So it is very difficult for a medical practice these days to hit 30. That one's been declining. Your trades, contractors, your home builders should be north of 10, 12 or better is ideal. And every point counts, by the way. Custom home builders will do a little better than track home builders as far as margin. Track home builders has more volume. Contractors, for the most part, gets 20% or better. HVAC is high margin, electrical is high margin, and windows is the highest margin of all. And so contractors is a very underrated business model as long as they're in an area that's busy. There they have to, definitely keep an eye on material costs and labor availability. So that's it. And then general service, I'm always looking for 20% or better.
Yeah.
And professional services can go 30 or better.
Yeah. And it's interesting, just by having that as a target, what I notice in terms of, it connects back tangentially to cash flow. But Kevin, I noticed that when I work with a client or one of our coaching teams working with a client, and they have a better understanding because their coach says, hey, you're at a 14% operating profit margin. Really, we should go for a minimum threshold of 20, but really our target should be 25 for you, later 30. It changes because their next reaction is that's impossible. And then we look at why is that impossible? You're right, it's impossible because your cost relative to your volume is off and you don't charge enough.
That's right. Yeah, it's often in pricing, but just the knowledge is useful because managing by margin, in my opinion, is one of the easiest and best ways to manage the business. And I do that relentlessly. And I'm sure my team's sick of hearing about it and maybe my clients, but I am all in on managed by margin. And knowing what your margins should be is great, knowing that minimum target. And full disclosure, when I started my own firm, of course, margin's high because it was myself and a helper doing all the work. But I had good knowledge of my clients at the large firm, what their margins were supposed to be. Now I had to learn, what was realistic in the small business world, but I had zero idea what my own margins should be until I went to an AI CPA conference and a guy said it, and I was like, well, that's great information. At the time, he said, minimum for a healthy valuation, a CPA firm was 33%. So at least I had a new target, and now my target's 40 or better, and we're running around 45. But I had no idea, right? And knowing that is helpful. The other thing is knowing what your other margins are supposed to be, your cost of goods, and in all businesses, labor margin. And one of the key things is that you got to keep that labor margin really in any business below 50%, or you probably don't have a viable business. And in the tight labor market with the labor inflation that happened, it takes a little more intentionality to make that happen. So managing labor well, and are you priced properly, right, to handle that labor, whatever your labor is.
Yeah. When I think about managing cash flow, as we kind of bring ourselves to wrapping up here, is I noticed that one of the mistakes is this, just the eye off the ball, right? We talked about looking at financials, but one of the ways you and I have had lots of conversation about, which is looking at the most important actual ratio or percentage numbers, right? Your gross profit margin, your labor burden margin, right? What you're looking at, and then your operating profit margin. Just those three numbers by themselves are really, really good nutshell that if those numbers go well, and if you stay on top of collections, more things tend to go well with cash flow. And then the second one I'll put out here as a mistake from my end is I see is the vanity or the misconceived purchases that an owner makes. Sometimes it's, hey, Kevin, I thought I was supposed to buy more stuff so I have less in tax.
Yep.
Sometimes it's more of, I wanted to remodel my office or I wanted to have this. And I'm like, well, you're welcome to do that, but you really should be making a calculation. Is that money well spent? And I was talking with a friend of mine who wrote a book, Kevin, called Less is More. This is a number of years ago. And in that book, he interviewed various business CEOs and owners of privately held companies. And one was an owner of a fairly large regional bank. And they were known in the industry for being really cheap in terms of like spending on headquarters and other things. Many banks had beautifully apportioned headquarters. Theirs was, stuff you could buy at a Staples, nothing bad, but it was fast and easy. You need another desk? Well, let's spend $300 on the desk. We're not going to spend $3,000 on this stuff. And lo and behold, when you had what happened in the 90s with savings and loan issues, many of these banks came into trouble. They didn't, because they really had cash flow under control. And one of it was they didn't make vanity purchases.
That's right. Yep. Yeah, and it's everyone that being a grown-up company is something where you have that level of financial maturity, and and so sales, that was the old saying, is vanity and profit sanity, and by doing that, don't spend it on dumb stuff, right? And keep it. The other thing to that point, any of these non-essential operating expenses should never be paid for out of your operating company. So a common example is buying a stupidly expensive car out of your operating company, right? That can be a vanity purchase on your personal side, not there. The other is I decided I want a building, right? And paying for that out of the operating company is often the death knell for many folks. It has nothing to do with your operating company. That's a separate real estate investment decision and should be funded separately. And incidentally, one of the things that's known out there, what's one thing that Warren Buffett never buys when he acquires the company? Never buys the real estate, ever. He buys EBITDA, right? And that's another way to keep cash flow solid.
Yeah. And truly, the key with that is that I want to make sure I make the real estate decision or the investment asset decision on its own merit, not as part within the picture of the business, which might be so profitable that it covers a myriad of sins. And so the real estate, I have plenty of clients that one of the best financial moves they ever made, and I know you own a portion of your building with condo,
right,
is buying their building, but that's a different decision. And just from an asset protection standpoint, it shouldn't be held by the same entity anyways.
That's right. Yeah. And so many reasons why it has nothing to do with your operating company. Yeah. And so that's a separate allocation of capital decision outside of your business. It may be brilliant, but it's not part of operations. Yep.
So Kevin, I want to go rapid fire with us here. I want us to go back and forth quickly here about simple ideas that are going to help us manage collections better. So I'll start us off, and then I'm going to go back with you. Not collections, excuse me, cash flow better.
Yep.
So we've talked, just a summary, we talked about getting timely, accurate financials, looking at them, making sure we look at managing by margins. Those are all things we've done. I'm going to say speed up your cycles. Can I produce what used to take me 45 days to produce my X service? Can I produce it in 30 days and bill sooner? That's one of my ideas. What do you got for me?
Yeah, absolutely. And I'll riff off of that. That cash collection cycle, the cash flow cycle is huge. So quick turnaround on executing, bill early, and then collect early. And that often, if you can collect some or all up front, you've just done it. My favorite example is Dell. They're part of the way they were able to scale so fast is they sold a computer online or on the phone. They were the first to do it. They did not take possession of the machine until it was actually assembled. So everything was on consignment in their warehouse. And then they had 90 days to pay their vendors. So they had a negative cash flow collection cycle. So
I love
fast
it.
is better.
And so for a small business, riffing off of that, how do I make my stakeholders, my bank or a portion of my line of credit bank, if I have a major projects coming through that are, who else is going to benefit from this? And how can I get them to help me by perhaps giving me 60-day or 90-day terms on something? You just mentioned that for Dell very
Yep.
commonly with that part. Perhaps I can even go to them for, if I want to test out some new marketing, for some co-op dollars where they're going to give me some money to do my marketing to help sell something that directly sells their stuff.
Yeah, that's absolutely. Co-op dollars is a great thing. Yep. So getting your vendors to help. So your customers that pay you early, vendors allowed to pay later, and then your internally turnaround time fast as possible.
I love it.
And that helps. And then you need less working capital.
And I'll
To
go
your
one.
point with the bank, though, everyone should have an operating line of credit at least set up, even if you never use it.
I love it. I love it. And I'm going to go one more that I'm going to ask you after this, Kevin, for what you would encourage someone to take as their number one takeaway from today. But I'll go one more, which I think this is one that's overlooked. It's pretty simple, right? How can I deal with seasonality? How can I moderate seasonality? The solution of I'm just going to fire my staff and rehire them in 4 months. I mean, I see that a lot in the community I live in, which has 6-month winters. That seems crazy. That seems unimaginative. How can I find valuable ways of offering value to the marketplace at a profitable number so I can moderate seasonality, whether that be through using better marketing, whether that be by having a backlog of work that I can work on in those non-seasonal times. Maybe I give a preferential price for that if they're doing it off season. How can I moderate seasonality? Maybe there's a new service line that I can do, but firing and hiring again is a tough way to go about it.
Yeah, exactly right. That's tough. So number one, if you can spread out your service delivery, that's a great start. Secondly, there's certain contractor business, right? Seasonality because of weather is not uncommon. So having a certain part of your team be subcontractors so that you have workforce on demand and maintaining a smaller in-house team. And we're going over with one of our contractor clients. They're like, why are margins always lower? I was like, we've been through this. You are overstaffed on the permanent, employee side. Just have your key piece. So that's one there. And additionally, if you do have seasonality that even after you've tried to manage it, using some cash flow tools so you can budget it and so you don't accidentally end up in what we call no man's land where you're out of cash is huge. And if you're a smaller business on the QuickBooks ecosystem, they've added an AI cash flow tool. So they've got a pretty basic one built into their softwares. If you need something a little more robust, some good apps that integrate with QuickBooks are Float, Fathom, JRav, which is JIRAV, and something called Cashflow Frog. Those right now are the leaders. And by the way, there's more than that. Those are kind of the leaders we've seen. And these are good tools that they can help you do it. You have to spend a little time working on it, but they can avoid that no man's land surprise.
I love it. I love it. What would you want people's biggest takeaway? Like I'll say that I would want, if someone's watching, listening, I always try, Kevin, to tell them, pick one piece that they're going to do something with. And so here's my takeaway. How can you speed up your cash flow cycle? If it normally is 90 days right now, how can you turn that into 75 days? If it's normally 75 days, how could you turn that into 65 days? Anything you do that speeds up your cash flow automatically makes it easier to manage cash flow. What's your big takeaway, Kevin?
Yep, that's right. So I agree with you. Velocity of money, I'd put that number one. And the other one is 10-10-10, right? At least to keep your AR below 10%, your working capital cash cushion, at least 10% of revenue, and then make sure any business you're in, that minimum of 10% margin, but find out what it is for your industry. And the higher the margin, the more cushion you've got and the more money you make.
Well, Kevin, thanks for joining me co-hosting for today's episode of The Business Coach. I really appreciate that.
Yep. As always, it's a blast. See you next time.
Yeah. Bye, everybody. We'll see you next week.